Hello everyone, I am Professor Suneel Maheshwari with the Division of Accounting at Indiana University of Pennsylvania. We'll be talking about the chapter on pricing today. And when we talk about pricing, it's one of the most important things that a business does, because setting a right price for the customer is one of the most important things. If the price is not right, the company is sure to go out of the market. Pricing can be looked from two perspectives, one from the perspective of external customers and one from the perspective of internal customers, or customers within the company or divisions within the company. So we'll talk about those two aspects today. First, we'll talk about the pricing with the external customers, where we talk about the target selling price and cost plus pricing. Also, we'll talk about another method with using time and material pricing. When we talk about the internal customers, we'll use transfer pricing to fix the price within the division. In this, we'll talk about cost-based, market-based, and negotiated transfer pricing. When we decide about pricing, there are many factors that come into play. So what is the objective of pricing? It might be to capture a certain market. What is the demand for the product? And whom are we targeting? As far as the pricing for external customers are concerned, the company must understand the market forces very well and how their product is unique and distinguishable from the competitors' goods. If it is not, then it is very hard for the company to charge a premium or charge a price at which they can make a reasonable profit. First, we'll talk about target costing. Target costing applies in those cases where law of supply and demand significantly affect the product prices. Basically, the company is a price taker in a way. It requires setting a target cost that will provide a company's desired profit. So to earn a certain profit, company must focus on controlling costs. When we talk about target pricing, we have got a market price which is more or less determined by the market niche in which the company is going to sell the product. After that, we have the desired profit. That is what the company wants on its investment. And then if you take out the desired profit, left is target cost. The company has to make the product within the target cost to achieve the desired profit at that target price. In a target costing situation, the company first will need to identify the niche in which it's going to sell, and then it will position the product to the target consumer and achieve a desired profit by making the product within the target cost. For example, over here, there's a company which can sell 200,000 units, but it can sell no more than the product for $20. It has an investment of $1 million, and it requires a rate of return of 25%. So to determine the target cost, we can first find the profit, that is the 25% of $1 million at $250,000. If you spread it over 200,000 units, that comes to about $1.25. From the target market price, you subtract the desired profit to get a target cost of $18.75 per unit. Now, the company needs to produce the product within that cost of $18.75 if it wants to sell the product. Another approach for external sales is cost plus pricing. In this case, there is a certain cost, and then you add the markup to come to the target selling price. So in this case, selling price minus cost will give you the markup profit. Now, the profit depends, or return on investment depends. You can find the return on investment using the formula net income over invested assets. So we know what the markup the company desires. Once they know the profit that is desired, we can come to that markup profit. So let's take an example of a Think More products, which is selling price of a new video camera pen. It will record up to 2 hours of audio and video. And here is the cost of direct material, direct labor, and total variable cost of $60 per unit. Now, it also thinks that the following fixed cost will be incurred at the level of 10,000 units. At the 10,000 units, fixed manufacturing overhead per unit will be 28 and administrative expenses will be 24. You have to note over here that if the budgeted volume and the cost plus pricing decreases, it will impact the cost per unit, because if suppose that budgeted volume goes down to about 8,000, your cost per unit allocated for the fixed cost will increase. So if it desires a return of 20% on the ROI of $1 million, so it desires a ROI of $20 per unit, that'll give the selling price of $132 total. So fixed cost of 52, which came from the previous slide, plus variable cost of 60, and 20% on $1 million divided over the number of 10,000 units gives you $20 per unit to give a total markup, total selling price of 132. So in this case, you have covered the cost, added the desired profit, and you have achieved a certain selling price. So in this case, if how do you compute the markup percentage? You can work it backwards. Your desired profit is $20, and total unit cost is $112. So it's about 17%, 17.86% of the total cost. And basically, if you add the 17.86% of the cost, you come back to $132 of the selling price per unit. Now, there are certain limitations with the cost plus pricing. One, it does not consider the demand side. Will the customer be willing to pay that price? Yes, that's our cost, but are the customers willing to pay that price or not is an important consideration. And second, at lower sales volume, the company will have to charge a higher price because it is going to spread the fixed cost over less number of units. So here is another example for the KRC Air. Suppose there is a 45% markup on the total unit cost. So in this case, your total unit cost is $71. A 45% markup, if you add it up on $71, will give you a target selling price of $102.95. Another approach in the cost plus pricing is the variable cost pricing. To eliminate the problems of arbitrary allocation of fixed cost, we can just use the variable cost plus a markup on that. So it's a very simple approach. You take the variable cost, add the desired markup, and you come to the selling price. However, the problem with that is the prices may be too high or too low in certain cases. If it is too low, it will fail to cover all the fixed costs. However, the variable cost approach is very useful in decision making. For example, when the excess capacity exists, variable costing might be a better method. Last approach for the external pricing we will talk about is the pricing of services. In this case, we can compute two pricing rates, one for the labor and one for the material. Generally, the industries which are especially professional firms or service industries in nature, for example, public accounting firm or law firms, engineering firms, they use the pricing services method where they compute two different prices for labor and material. Labor generally will include the direct labor time and other employee costs. For material, it might include cost of direct parts, materials, material loading charges for related overheads, as well as some labor costs which are directly associated with that material. For example, over here, Lake Holiday Marina is into the boat and motor repairs. There are various time charges which are included. For example, mechanics wages and benefits of $403,500. On the other hand, we have got some material loading charges. For example, office manager's salary, part of office manager's salary and benefits, and total budgeted cost for time components of the time are 151,000 and material loading charges is 28,200. Now we'll compute a separate charge for each one of them. To calculate the labor charge, the direct labor cost is included, fringe benefits are included, and in labor rate, 5,000 hours of repair time is there. Desired profit margin is $8 per hour. So if you look at the total cost for the labor, you divided the total cost by the labor hours to come for the price hour charge. And you come to a total cost of $30.20. To that, you add the profit margin of $8 to come to a total cost of $38.20 for the labor charges. The second part is the material loading charges. So you take the estimated purchasing, receiving, and handling costs and divide it by the cost of parts and materials. So please note the basis is different in this case. You are computing this as a basis of the total parts and materials purchased. And then you add the desired profit margin to it. So in this case, your total purchases were 120,000 and your total cost associated with it was 28,200. So it is approximately, if you add it up, about 23% is the material loading charges. The profit margin expectation was 20%, so the total material loading percentage is 45%. So we have got two rates now, one for the labor and one for the material. So we'll calculate for a particular job, use that application for a particular job for Marina Corporation. So in this case, this particular job took 50 hours of labor time and $3,600 in parts and material. We found the labor rate to be $38.20, so 50 hours multiplied by 38 hours, $38.20 gives you $1,910. Cost of parts and material was $3,000, and then your material loading charges, which came to 43.5% earlier, is total of $1,566. Total charges for materials and materials handling is $5,166. So total repair charges on this 50-hour job comes to about $7,076. So this pricing service method is used by many service industry by computing two separate rates, one for the material, one for labor, and add the material loading charges to it. Thank you.